In this video, we're going to talk about Ocugen, trading under the ticker symbol OCGN. We're going to cover the price action over the past few days, the company itself, and the recommendations regarding buying, holding, or selling the shares. If you would like to see more stock analysis videos, please like, comment, and subscribe to my channel. But before today's video begins, I'd just like to clarify a few things about the timing when my videos are recorded, uploaded, and how much they react to the latest market updates. So most of my videos are recorded and scheduled the day before and uploaded for the next day. For 5 days out of 7, it's a trading day, so of course by the time the video goes live on my channel, the price would have already evolved from there. If there are significant and very volatile movements during the trading day, obviously they will not appear in the video on that day. But usually, to the extent possible, my analysis will be based on the medium term and not really focused on the intraday movements. The reason why it shouldn't matter that much either way is because most people investing in stocks invest for some kind of reason that takes time to get developed, and that their positions are usually kept for at least a few weeks. With that being said, if there are significant stock price movements that happen afterwards, either they will not affect the overall picture, or if they're significant enough, they will be mentioned in the next video about the stock with re-evaluations of the circumstances as needed. Ocugen is a medical company founded in 2013 in Malvern, Pennsylvania. It operates in treatments for ocular issues, which is hinted in the name of the company. It carries a contract of distribution for a major Indian company in the United States called Bharat Pharmaceutical. Its appeal is the expectation that the authorities will eventually allow the distribution in the short term in the American market, which will then significantly increase its cash inflows and encourage more upward momentum. Compared to the other better-known companies that have been making the headlines, it is a relatively unknown company and does provide more potential upside in the future if there are catalysts present. Aside from that, the company also improves its profitability with its other operations and does offer a strong appeal to the market for capital that is willing to tolerate a relatively high risk with its investment. The market cap for Ocugen is currently at $1.54 billion, and the enterprise value is at $1.32 billion. The market cap is the price tag financial market is willing to evaluate Ocugen's stock at, considering its future potentials and the short-term fundamentals. The enterprise value of the company is the net result of the company's assets once all the debts are paid back. Usually the market cap is higher than the enterprise value, but sometimes there may be exceptions because the company may be highly leveraged for the company, because it could be under a lot of selling pressure from the market, or like other special situations going on within the management. The quick ratio for Ocugen is 18.21, same goes for the current ratio, and the debt over equity is 0.0294. In other words, the company doesn't have a lot of debt and its assets are highly liquid. I don't expect to see a dilution anytime soon. The average trading volume of Ocugen has been 21.13 million shares, and the daily volumes have been 22 million shares, 14.1 million shares, and 13 million shares over the past few days. So in a way, things are quite constant with how many people are willing to buy and sell Ocugen on an ongoing basis. And this kind of correlates with the fact that Ocugen's volatility hasn't really been picking up recently. Things are mostly just going on a constant basis, and I think that we need to see more catalysts coming its way before the stock makes some significant movements, which in my opinion should happen over the next 1 or 2 months. The 1-year beta of Ocugen has been 6.27, which is, in other words, very significant because this means that it's 600% more volatile compared to the market. its 52-week high is $18.77, and the 52-week low is 29 cents. Now, let's also talk about the options market for Ocugen. In terms of volume and open interest, the options market seems to favor the calls option side. Generally speaking, the put options mean that the market expects a downfall, and the call options means that the market expects the price to go up. The key strike prices where there seems to be the most interest at are $8, $8.50, and $9. So regarding the appeal of Ocugen and whether you should buy it or not, I think that initially a lot of people, myself included, believed that Ocugen was going to be a one-time deal. In other words, assuming that Bharat Pharmaceutical is able to get the authorization, Ocugen gets a big contract, and then everybody just plays the narrative and it'll shoot up and maybe probably grind down lower afterwards. But now it seems that this demand has evolved. It's no longer a one-time deal, and it may come back year after year under different versions. So instead of being a one-time event, I think that this will provide like a more constant baseline and arguably a higher baseline for Ocugen's stock price in the years to come, because this would become essentially one additional revenue stream. And keep in mind that even though right now it's mostly a distribution play, the fundamentals are also kind of encouraging. Like, the company is having more cash on hand, it's having less operating loss quarter after quarter, and it's also applying for different tests for its other operations. So overall, I think that things are good from a fundamental perspective. And recently, Bharat has been able to get more recognition from different countries around the world, namely the United Kingdom and India. And in terms of price action, it hasn't really moved that up compared to where they were a month or 2 months ago. At least the baseline remained to a similar level. So if you want to enter in the stock now or to buy more shares of Ocugen, I think that now is a good entry point, because the $7 level, in my opinion, is a pretty solid support line that there really has to be some like significant market news for the stock to change. Another question that some of you may have is if you would stay short or long term. So the short term is mostly a narrative play. In other words, as soon as they get the distribution contract, this is enough to move the stock. The long term is more uncertain and in a way is more based on like the sales numbers or the cash of the company quarter over quarter instead of relying on narratives. So it's less predictable, but it's probably going to be less volatile as well. So my recommendation is to keep a mostly short-term approach with Ocugen and maybe use like, I would say 10 to 20% or maybe 30% max of your allocation, or just let's say you were able to make a quick profit with the Ocugen stock. Use the profit to stay in the company for the long term and get your initial investment out so that you're able to stay in the company for the long term. This could work as well. So my recommendation is to probably go for 1 to 3% overall of your portfolio and to buy 50% of your allocation now, because the price is very close to the support line of $7. In the current market environment, I think that we should be careful about taking positions in the financial market in general, especially when it comes to equity market. Over the past decade or so, the financial market has been living with the help of newly created capital from the quantitative easings, which resulted in the increase of asset prices and the corresponding collapse of their yields. Of course, the low interest rate also contributed to reinforce that phenomenon, because the financial sector would first of all see its profit margin squeezed, which will in turn keep the returns of other sectors low as well. At the same time, the market doesn't represent the real economy, and the real economy often doesn't get reflected in the prices of their own securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. And I want to say that fundamentals sometimes doesn't play that much of a role at all. If the asset prices only depend on the fundamentals, then their performances in Northern Hemisphere would have been more than mediocre, because things have mostly been stagnant over the years, ever since the last economic recession. A few things can explain why asset prices managed to remain high during these years, despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their local economies. But because that money is distributed to banks and expected to be loaned to businesses, and that there aren't that many opportunities in the real world, the money went into the financial sector to buy up assets. Of course, the QEs are wrapping up in many countries, so for the next couple of years, it's not going to be the main driving force to keep the asset price high. But it's compensated by the arrival of new capital from different regions in North America, because it's still perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be a sustained phenomenon over the years to come. The last phenomenon is the creation of artificial bubbles that are either supported by the real market trends or completely fictional to allow market participants to play the game of hot potato and to either generate profit or to safekeep their capital. Of course, the people who end up with the hot potato lose money, but that's another story. The EV sector in 2020 is an excellent example of this. Nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially in Asia. This means that the market is expected to see its volatility increasing over time, which will provide opportunities to make a profit or to incur losses depending on the timing and risk management of those portfolios. Another thing to note for this period of time is to be very careful with having short positions. Usually, it's already more risky than having long positions because losses are not limited. And with the increased involvement of retail traders, I believe that the stocks being shorted will have a higher probability of getting squeezed, and this will occur randomly, which will result in potentially massive losses. We're also observing very often people will choose to rush in positions not necessarily because the fundamentals are convincing, but because there is a buildup of demand in a specific stock, and that people will pile in to ride the gravy train with the rest of us. This kind of behavior is highly risky and may result in heavy losses as well. It's worth pointing out that in 2020 and probably in 2021 as well, the financial market has never presented that many opportunities, but it's also during this period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. The positions should also begin small so that there is an opportunity to average down later. Typically, the growth stocks would take about 5 to 10% in my portfolio overall, and each and every one of them represents maximum 1% of my portfolio. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.